What is an S corporation? All an S corporation is a small corporation. So it's a corporation like Walmart or Target that has now decided it wants to be treated as a small business. And in order to keep bigger players from utilizing the benefits of a small business corporation, they have various restrictions on who can be an owner of them, but we'll get into that later. First, let's talk about how to convert to an S corporation. So the first thing you need to do is either have an LLC or a C corporation. You can open either one of those with your state. Now an LLC has one additional step. An LLC is very flexible, so it can elect on Form 8832 to be taxed as a C corporation. You would file that form first. Next, you would file Form 2553 in order to elect S status. Now, if you just form a regular C corporation in the state, then all you have to do is elect S status with that C corporation. So now let's talk about some of the pros. And one of the greatest pros of the S corporation is self-employment tax savings. So let's say you have a great year, you make $100,000 after expenses. All $100,000 of that money is going to be taxed on self-employment. That means you're going to have 15% extra tax on everything that you pay. This means that you're going to have a 15% tax on the net amount on that $100,000. You're going to have $15,000. Then you're going to have regular income tax. So let's just say it's 20% to make it even. You'll have a $20,000 tax bill for income tax and then a $15,000 tax bill for the self-employment tax. Total of $35,000. Well, now let's bring in the S corporation. S corporations are required to pay their officers reasonable salaries. So let's say that you use $50,000 as a reasonable salary. You're going to have $100,000 in net income minus your $50,000 salary. So your net income for the business is $50,000, and then your reasonable salary is going to be $50,000. So at the end of the day, you're still taxed on $100,000 for regular income. So you're still going to have $20,000. But that $50,000 of wages that you pay yourself, that's the only thing that's going to be subject to that self-employment tax. So 50,000 times 15% is going to be 7,500. So 20,000 plus 7,500, now you have a tax bill of 27,500 as opposed to 35,000. Kind of a big difference. So what's great about that is, let's say that you make even more money than that. You make 150,000. Well, instead of having 150,000 subject to 15%, you still only pay yourself that $50,000 salary. Well, then your self-employment tax is still going to be that 7,500. We'll talk a little bit more about the cons of having the reasonable salary later, but that's one of the biggest benefits is as your income grows in the business, as long as you're paying yourself a reasonable salary, you can minimize those self-employment taxes. Another great thing about S corporations is they have very low audit risk. I want to say the last statistic I heard was that less than 2% of S corporations are audited. They are very safe entities for whatever reason. Now compare this to a Schedule C on your personal return. If you have any kind of large income or a loss on Schedule C, it's a very big red flag to the IRS. Generally, those are things that they look at. So if you don't want the IRS knocking on your door, an S corporation is a great way to go. Now, one of the other good things about having an S corporation is that it provides limited liability. Similar to like an LLC providing limited liability, means that if somebody tries to sue you and come after all of your assets, they're limited to what's inside of the company. So they can go after the assets, cash or vehicles, whatever you have in there. They can go after that stuff, but your personal assets, your home, your personal car, stuff like that, those are generally not in the scope of any kind of remuneration to them. Now, also similar to a limited liability company LLC, it is what's called a pass-through or flow-through entity. This means that the S corporation itself does not pay taxes. Say the business makes $100,000 at the end of the year. That flows through to you onto your personal return, and then you pay the tax there. Now, a normal C corporation, say like Walmart, they pay tax at the entity level, right? So if they make $1 billion, they're going to pay tax on that. And then if they pay dividends out to their shareholders, the shareholders also pay tax on those dividends. So there's a dual tax there. The S corporations avoid that by having only one tax at the personal level. So to kind of recap, the primary benefits of having an S corporation are 1, lower self-employment tax, 2, limited liability, 3, a flow-through or pass-through entity kind of income where there's no entity level tax, and 4, a very low audit risk. So now let's move on to the cons of having an S corporation. It can all be good, especially with taxes. And first, let's talk about the reasonable salary requirement. So a lot of people view this as kind of a game, right? A game that you play with the IRS. You want to pay yourself just enough to where nobody questions it. You make $100,000, you're paying yourself $50,000. The IRS might not bat an eye. They could, but they probably won't. But let's say that you're making $1 million and you're paying yourself a $50,000 salary. The IRS is probably going to have a problem with that. What they're going to do is they're going to compare your salary with your distributions at the end of the year, and if the distributions are much, much larger, they can and have done where they've come back and reclassified some of your distributions as wages, and then they charge that self-employment tax on your wages. So then not only are you paying the tax, you're going to have penalties and interest on top of that. So at this point you might be asking, what is a reasonable salary? There's no real hard and fast rule on this. Basically, my opinion, and this is just my opinion, you should be paying yourself what you would pay another person to come in and do your job. So let's say you wanted to be a passive investor, you didn't want to handle the day-to-day operations anymore, and then you put out a job description. What amount are you going to pay this person to come do your job? That's a reasonable salary. Now, the IRS also has some guidelines on their website on what you can use to kind of determine what a reasonable salary is, but ultimately, that's kind of what I've boiled it down to, is what would you pay somebody else to do your job? So another con with S corporations is the additional complexity that comes into having just another entity, right? So S corporations are a tax reporting entity. They file another tax return. Now, if you were just a single member LLC, you would just be filing everything, say, on your personal return. What that means is you're going to have to be working with tax professionals. You're going to have a separate tax return prepared. So there's going to be some additional costs associated with that. And also with paying yourself a reasonable salary, that means you have to be running payroll. So you're going to have to find a payroll company. You're going to have to be running either a regular or a one-time payroll, it depends on your needs, but you're going to have to be filing payroll reports, stuff like that. There are additional administrative issues that come with having an S corporation. So that means additional costs. So another con for S corporations is that some states don't recognize the flow-through entity nature of the S corporation. Let's take California, for example. They have a state level tax. So if you're going to file an S corp return in California, you're going to have to file its own return, and then there's a minimum tax of at least $800 that you're going to have to pay with each return. But California is one that doesn't really recognize the flow-through nature of the entity. And one of the bigger cons of having an S corp is the limitation on ownership. So S corporations are limited to only 100 shareholders. So you can't have a massive amount of shareholders like you could, again, say like with Walmart, where you have thousands of stockholders. And the reason they do that is they're trying to keep the entity small in nature, right? Small business corporation. So that means that other types of entities are also restricted from owning stock in the company. There are only certain trusts that can have ownership in an S corporation. C corporations cannot own part of an S corp, neither can partnerships, and also you have to be a US citizen, so no non-resident aliens. Now, where this can be an issue is if you're ever trying to raise capital. So if you're ever trying to bring in investors, and a lot of those investors have, trusts and C corporations and things that would be injecting that kind of money, you're going to be restricted. You might have to relinquish your S status and go back to a C corporation in order to raise any kind of significant capital. So to recap on the cons, 1, there's increased scrutiny on what is a reasonable salary. 2, there's additional complexity and costs that come with having an S corporation. And 3, you're limited to exactly what kinds of investors and how many investors you can have in an S corporation. And last, some states don't recognize the S corporation status. You might still have to file a state return there and pay entity level tax. So all this kind of leads us to, when should we be forming an S corporation? So you have an LLC, you want to convert it to an S corporation, when is the appropriate time to do that? Now, generally, because of the associated costs that come with owning an S corporation, I would say you probably need at least $40,000 to $50,000 of net income to justify having that reasonable salary and getting rid of the self-employment tax. That's kind of when the tax savings on the self-employment make sense and overcome the costs associated with running an S corporation. You don't want to do it just at that level, but if you expect continued growth, your revenue's increasing and your costs are kind of leveling off, that would be an indication that's probably a good time to convert to an S corporation. But remember, we're all unique snowflakes in our own way. We're all going to have different needs. Everything is going to be specific to you. Make sure you consult with a properly certified tax professional or a CPA on what's best for you. Remember, just because I'm a CPA doesn't mean I'm your CPA. Well, everyone, I hope you found this helpful. If you feel like I've earned your subscription, I would greatly appreciate it. It would really help with the growth of the channel. As always, I wish you the best in your tax and business journey. Best of luck.